Hello and welcome to our weekly look ahead at the markets, and we've had quite an interesting run into the end of September, and just as we head into the final quarter of the year, we're going to recap briefly what's happened over the last few days. We did see stocks just come back a bit on Thursday, Friday. Oil pulled back from that 13-month high, and the US dollar also retreated towards the back end of the week. So just giving back some of those gains, and that sort of pullback in oil and the dollar and yields to an extent as well just offered some respite to equities. Really the story though of last week was spiking treasury yields. We saw fresh 16-year highs on that 10-year, and we saw spreads widening in Europe, with Italy signalling that its deficit is going to be a lot higher than previously forecast this year as well as next year. France also getting a rap on the knuckles for exceeding its deficit target as well. So a sign really that maybe that deficits are going to be structurally higher. We've also got that US government shutdown to bear in mind, and again that plays into the deficit story. So structurally higher deficits, and we get a sense that bond vigilantes are back in the game and pushing the long end of the curve higher. So coming up in the coming days, we've got a couple of central bank decisions. First up, the RBA is expected to hold, although we did see inflation just tick higher in Australia. We think probably for now the RBA will sit on the data and not want to pull the trigger too soon on any further hikes, having signalled that it's near the top. RBNZ, New Zealand Central Bank, also in action. We think probably there might be something left in the tank for New Zealand, but maybe not this month. So keep your eyes on that one. If they decide to pull that forward, that might nudge up on the Kiwi dollar. And then also Nonfarm payrolls is a big one, of course, coming into the end of the week on Friday. That last month was a little bit higher than expected, but revisions took the 3 months average a bit lower. Unemployment ticked up quite a lot, actually, from 3.5 to 3.8%. Lots more workers coming into the US labour force, and the US economy not quite able to absorb them all that quickly. So that's pushed up the unemployment rate. That means the labour market is a bit looser than it has been, and that's really what the Fed's been looking to see. That's what it's been aiming for, as that will help to make sure that wages don't keep forcing their way higher and pushing up inflation expectations along with them. That said, though, of course, we've got oil prices trading at year highs, so we'll keep an eye on that. That's certainly raised some fears that inflation is flaring up again. But Eurozone inflation data on Friday was showing signs of strong disinflationary trends in the euro area, so that's something that the central banks can look towards. So as I say, coming up this week, a couple of central bank decisions, non-farm payrolls, and keep your eyes also ahead of those non-farm payrolls on ADP, JOLTS, and the weekly US unemployment claims data. That's it for now. Thanks for watching.